I mentioned earlier that the Bank of England says the massive amount of money going into the AI boom threatens potentially to destabilize the financial system. Let's get more from Dan Rohinton, portfolio manager at IA Global Asset Management. Dan, thanks very much for joining us. I think I've read that in previous bubbles, people know it's a bubble. They say, yeah, it's a bubble, but they go on buying. I guess everybody hopes to find a bigger idiot to sell the stock to.
Or it's just a question of where we are in the cycle. Is it really the debate? I think where we're talking about today is it 1996 or is it the cusp of 2000? So when these conversations tend to happen, you go to the last major cycle. So every time there's something going on in the financial markets, everyone goes to 08, 09. Anything that happens in technology, people say, well, this reminds me of Cisco or Nortel. And I think it's important to say there are differences and there are similarities. The size and the magnitude of what is going on today is without precedent, but so is the level of adoption. And I think that's really where the rubber hits the road, Andy, is we don't know the answer to that just yet. So we can both say this is the largest CapEx cycle we've seen in a generation and then some, at the same time as we've seen the fastest adoption of any technology ever, and both are true at the same time.
You know, it's interesting. Justin Fox is a Bloomberg columnist. He's been crunching numbers. He says, oh, sure, AI spending is major in terms of its economic significance, but it has yet to become the force that tech and telecom were in the late 1990s, because, of course, the whole economy has grown.
I mean, I would debate that point. I'd say technology has diffused into so many facets of society in a way that isn't directly measured in GDP. So think about if you had to charge for Google, if you had to charge for social media, if there was an explicit cost to that, or YouTube before the ad-supported elements have really taken hold. So I'd say there's massive diffusion of this technology across all facets of society, and we're just getting started. But that doesn't mean, and this goes into more of a technical concept called consumer surplus or surplus that flows to big corporations and the general stock market, is this just going to be a common good where the deflation means that everyone gets a great service for a very low price? Or does this create the next of the Magnificent Seven and that turns into the Magnificent 10 or 15 or 20? So I think the question is, can you get price for it? And can you get real value for it? And can you get to hold on to that profit pool over time? And these are the questions that the market is testing right now. And I think there's a chance that a lot of these things are actually going to be great for consumers at a very, very low cost. And the companies will have to basically give away many of their products just for getting a few core marquee assets where they can really build a moat around it.
I don't know. As a consumer, I see myself having to deal with AI agents and the companies can, of course, manipulate pricing better, can't they, as well? I guess there's always puts and takes with this stuff.
And sorry, on that point, Andy, I think it fundamentally comes down to what is your position in the value chain, right? So are you in a competitive industry, in which case then the benefits of being able to bring down the cost of customer service because an AI is answering your phone call, if you're complaining about your cell phone bill, as an example, those things can get competed away very quickly because if one company adopts it, they can take market share and offer that service for a far lower cost, and then their competitors have to match. But if you have a durable position in your value chain, that margin is yours to hold on to.
Dan, gold, what do you think? Do you see upside for it? I know that's a perennially impossible question to answer, predicting gold's moves.
I mean, I'll be honest in saying I'm a little bit nervous about where we're heading because it goes back to the general narrative around gold is exceptionally constructive right now, and everybody is bullish. And then you should maybe take a step back and ask yourself, what are the reasons for that? So a Federal Reserve that is looking past inflation and towards jobs is a very constructive environment for gold. Central banks buying, and then the general push across all of retail as a store of assets. That all sounds great, but we have to take stock of the fact that gold's up almost 20% in the last 2 months, and it's also up very significantly in the last year and a half. And the last several times that this has happened, there has been a huge step function change in the monetary regime or some type of major crisis is unfolding. Think of COVID, think of the global financial crisis. So I'm getting nervous on gold. I think 4,000 sounds great. It's a great technical barrier to break through, so on and so forth. But it takes one or two negative data points to the gold narrative from here. So imagine a Fed that says maybe inflation is becoming a bit of a problem. Then see what happens to gold. And I think the AI and the gold conversation have more in common than they have in being different. And what I mean by that, Andy, is that NVIDIA AI is an open-ended dream the dream, from robotics to challenging the Klingons for interstellar domination, open-ended narrative. Gold is that very same thing. And the underlying common thread between the two mega cycles that we're going through is an easy money Federal Reserve that's keeping financial conditions easier and cutting in basically a negative, basically moving towards negative rates. So I think there's a lot of overlap between these two conversations.
Dan, always great talking to you. Thank you very much indeed.
Thank you, Andy.
Dan Rohinton, Portfolio Manager at IA Global Asset Management.